All views, opinions, and comments expressed herein are solely those of the speakers and do not necessarily reflect the views or opinions of StoneX Group Incorporated and or its subsidiaries. This content does not constitute an offer or solicitation to open a trading account, to trade in any specific product, or to engage with any services provided by StoneX Group Incorporated or its subsidiaries. This content is not intended for residents of any particular country or jurisdictions where such content is prohibited.
Welcome to the Trading Global Macro podcast from StoneX, where we unpack the complex forces driving global financial markets. I'm John Kicklighter, Global Head of Content at StoneX.
And I'm Matt Weller, Global Head of Market Research for StoneX's self-directed brands. Each week in this podcast, we explore the macroeconomic trends and geopolitical events shaping Forex, equities, commodities, interest rates, and more. We're back after a bit of a hiatus here, so appreciate everyone joining us. John, what is our topic today?
I think our topic today is sentiment, which is always a factor. So I won't say it's particularly one now, but it is. But when you talk about sentiment, it has wide-ranging references. So actually, on one of our first episodes, we talked about more of the extremes of sentiment and how that can impact the market and how markets draw from that sentiment to develop pricing, develop perspectives, seize runs, reversals, fads that rise and fall. And it has just a broader consideration outside of another theme that we talked about before, what you consider to be all the tangible or known data. Around that data, around that information that is objective and all out in the market is sentiment. And sentiment turns into speculation and expectations and forecasting. So it arguably has some of the greater impact on the markets overall than almost any other of the factors, although that's very debatable, and we've had that debate somewhat in the past. But what would you say? What would you add in terms of the importance or what reflects or represents sentiment for markets?
Yeah, I view it for traders and investors as kind of like the third leg of the stool, in addition to fundamental and technical analysis that many will be more familiar with. You can think of an example where the fundamentals for an asset are supportive and maybe the technicals are breaking out after consolidation. But if you don't consider the sentiment or the positioning, if everyone's already bought that asset, then it's going to be difficult for it to extend its gains further. So I think it can provide a unique source of insight that you might not get from some of the more traditional ways of looking at markets. And for that reason, I think it can be very valuable, especially as you alluded to earlier, when it's at extremes. That's when you get the strongest signals from sentiment. A lot of times, as with everything, sentiment's somewhere between the 10th and the 90th percentile. In those instances, it maybe plays a slight supporting role in other forms of analysis. But when we get to those extremes, that's where I think it's really important to note that. And hopefully it's something that can be incorporated to help become a more successful trader and investor. So I think you ignore it at your own peril, especially at certain times when it's at those extremes.
Absolutely. Sentiment. There's the rational, there's the emotional. I think it's a human consideration until the AI takes over all of the trading, which I don't think it ever really will. Which we can have a separate conversation on that. But the emotional aspects of those assumptions, those outlooks, those misprioritizations or differing prioritizations will always lead to significant amounts of volatility. So I just think it needs to be considered, and I think there is a reversion to mean with anything. Volatility, price to some extent has a reversion to mean, but sentiment certainly has a reversion to mean. Definitely snaps back. So with that being said, I think we should go into some of the different measures that we have for sentiment, and there's general categorizations of these measures, although we were kind of debating on what the best names would be. But setting those category names aside, I think they're very practical in terms of the insights that they give, and there's benefits and there's detriments to each. All of this is tools. There is no perfect measure. There is no one step solution. There's no silver bullet, so to speak, not even AI. We will talk about the AI in this as well. But let's start with, I think, one of the more popular ones. I think hopefully everyone's aware of it, but the CNN Fear and Greed Index, kind of a kind of a hallmark alongside something like the VIX volatility index, which is more of a fear indicator. But this gets both categories or both ends. What do you think of this indicator, Matt? Do you think this survey-based sentiment measure is valuable, and how do you think it could be incorporated, and what are the shortcomings?
So I honestly would not include something like this as a sentiment indicator. I know that's how they pitch it, but for our audio listeners, John has it pulled up here. If you were to scroll down, John, you can see how it's derived, and to me, it's more of a technical indicator. It looks at things like market breadth and volume profiles and trend, things that you can pull up essentially on your chart, and they're just sort of cobbled together to try to estimate sentiment in the market. I think as a proxy, I suppose it serves pretty well there. But what will become a common theme throughout this episode is that I think that the unique insight that sentiment can offer is how people are actually positioned, not trying to interpret that or interpolate that from other data sources or asking them, and they just kind of put their finger in the wind and say, hey, I'm feeling good today. So from that perspective, it's not something I use a lot in my analysis. Again, at the extremes, maybe it's something that's worth noting, but if an indicator like this reaches the extremes, you kind of already know it just looking at a chart, because a lot of this data comes from the price action, the volume profile, some options data as well. So maybe you could call this at least a proxy for sentiment, but frankly, it's not in my core rotation of sentiment measures that I use. What about you, John?
I'm the same. I don't really reference this unless it's somewhere in the middle to give a more extreme measure. And the thing you touch on a point here. A lot of this, just like I don't use oscillators anymore as a technical tool, because I generally have been looking at enough charts for enough time that I can tell where an oscillator will be depending on the look back period. And I just don't need something that's going to give me a moderate measure of sentiment. And I usually take it and I say, let's look at this extreme that this signal is giving, and then looking at it out of their sentiment tools. So it's never by itself, and it's rarely do I reference it unless I know it's going to be at the extremes. And then that's just to add up the context, or look for those more controversial. This one says greed. This one seems fear. And in that debate, which one is more accurate? This one I don't feel is particularly accurate, but that it's always good to add in. So with that being said, what are your sentiments on the AAII Investor Sentiment Survey?
This one's maybe a little bit closer. It tries to be forward looking. I believe it asks a group of investors about their expectations for the stock market maybe 6 months out, and essentially are they bullish or bearish or neutral? And of course, by removing the neutral component, then you can get a bull bear spread. So in some ways, I think this is kind of an anachronism. It used to be very useful in the past. Now, though, as we talked about in our top lessons from 2025 podcast, a lot of this survey based information, I think, is losing its relevance. People are increasingly politicized. The obviously factors unrelated to market expectations can still play into people's market expectations. So I think it's worth keeping an eye on at extremes, but in some situations, I think we'll see very sharp shifts here, for example, around different elections. And that's because certain people suddenly felt worse about the stock market and the economy after the party that they didn't support became in charge in Congress and in the White House. So I think a lot of the same surveys suffer from a lower response rate, increased emotionality, I guess, among the people being surveyed, that some of the signals aren't as valuable. I'll still take note if there's an extreme in something like this, because it does try to be forward looking and again can maybe serve as a proxy. It's unique data that we can't get from just looking at a chart and making our own technical indicator, unlike the fear and greed index. But again, this is one that probably I wouldn't put in the top tier of most useful sentiment indicators, at least for me.
Ditto. Again, it's useful at the extremes, and it's useful for forward looking, but there's not really, what's the term? There's no stake in it. You're not looking at somebody who's actually saying this is my book or this is my exposure. You're just saying this is how I feel, and that is very questionable. Even relative to the fear and greed index, which actually does pull from market-based indexes, which are live exposure. AAII is a little bit more dubious. That's why I don't even consider in this list sentiment surveys that you get from Sometimes the central banks have them from. I think they do it monthly, where they pull from various market participants that deal with the central bank. They ask them their forecasts. So I don't even include that because it might not be indicative or accurate to their views, and especially to a level of extremity. So, like if I'm extremely bullish or extremely bearish, you don't necessarily get that granularity. So let's move away from surveys that don't necessarily have any stake in the game to ones that
Please.
do have stake in the game. We'll start, I guess, with the prediction markets. I think that's I mean, we can question volume. So this is
Mhm.
for those that aren't looking at the probability of a recession in the United States for the year of 2026. Probability is not very high, but the volume behind this is not particularly high. So you're talking $388,000 worth of exposure, which I guess for a prediction market, which was relatively nascent, that's pretty good. But it isn't particularly large. You have some other ones that I've seen that are very large, like over $250 million volume behind whether the United States will strike Iran through
Mhm.
I think June. So that's a lot of capital or exposure. But this starts putting at least money behind it. Now, this is kind of like a more extreme version of the crypto markets or meme stock trading. The participation is further and further away from the expertise you're usually looking for to help give some insight on that. But sentiment is very valuable when you start putting money behind it. What are your thoughts on the prediction markets, which we talked about in the past, but in terms of sentiment?
I think they can be useful, and I think they'll be increasingly useful. At least that's my guess. Just as they become more widely accepted. I know both Kalshi and Polymarket ran commercials during the Super Bowl recently, so I do think that they're getting more interest here. And then as they get more liquidity, that can attract more professional operators that presumably have a more refined view and can look for opportunities to push those markets more toward efficiency. So I think it's a promising new area. Obviously, there's not a large track record. You mentioned the disclaimer about volume. You always want to keep an eye on that. And you can also see that in the spread between yeses and nos. Sometimes that's very wide, such that even if you think the ratio's off somewhat, it kind of takes some of the juice from the squeeze. If you were to place that trade, if you think there's actually a 30% chance of a recession this year, but you had to buy the yes up at 27, well, that's as of this recording, kind of taking a big chunk out of the potential profit from that and makes it less compelling. So with those caveats, I do think if you can find some deep liquid market, this is, in my view, a great measure of sentiment because people are putting their money behind it. They stand to lose if they're wrong. They stand to make money if they win. That's a very classic incentive alignment that generally should motivate people toward a more accurate view. So it's promising, and I would say I certainly check prediction markets around, especially areas where I don't have a lot of expertise, more often than I'd look at something like an AAII sentiment survey or even a fear and greed index. So I think it's one that I like to have in my rotation. I don't defer to it entirely, given some of those pullback or some of those drawbacks, but it's certainly promising in my view.
Yeah, and so two of those drawbacks, the volume or open interest, which is what we talk about in derivatives markets, and but one of the benefits is the extreme flexibility. So the extreme flexibilities are essentially, to a large extent, binary options contracts,
Mhm.
but you have to really make those well. Otherwise, you lose some of the relevance of the conversation or the market that you're trying to project. And I think that we can look at something that's at the extreme opposite of those two considerations, those shortcomings, and we can look at something like FINRA has investor credit. Essentially, this is the difference between the money they have on hand, the cash they have on the can, and their margin accounts versus how much they're borrowing. And that difference is essentially, you could call it leverage. I know retail markets are really used to leverage, but it's not necessarily used to extremes in those non-retail accounts. But if you've been looking at the FINRA investor credit measures recently, it's really leaned heavily into borrowed exposure, some massive numbers at this point, which, you can look into this. This is a very unilateral look, rather than Kalshi or Polymarket or betting markets can have all this degree of flexibility. And you can see these different aspects from different perspectives, like the Polymarket, I believe it is, the betting around when the U.S. might strike Iran. It has multiple days or multiple expirations, if you will, if you want to make it corollary to derivatives. But this is very straightforward. This is also a backwards-looking measure, but the volume is enormous, and so it's kind of an offset almost directly to the betting markets in exactly that way. But you can see with markets pushing record highs and the markets, or at least this market, drawing record borrowing to participate. That can be a sentiment measure. Also, something we didn't talk about yet, but the sentiment measure to an extreme. You start to look at it as a contrarian indicator. We're very optimistic and we are borrowing tons of money against it. Not necessarily that I can call an end to a trend or a market, but it can say there is a lot of risk that you're overexposed potentially. So this is another measure that I think it really is remarkable. Let's take another look at the COT, the Commitment of Traders. This is particularly in the futures market, and there's different. The futures exchanges will measure, or the Commitment of Traders from the CFTC will measure different exposures on a regular basis every week, usually through a Tuesday, and it's released on a Friday. And what they do is they can show, and what I have on the chart for those who are looking, are a net speculative positioning. So taking a specific group, maybe not some of the larger industrial players or what have you, or the hedgers, but more so the ones that we know them to be more speculative in nature. And that group is aligned to more heavily expose themselves to emotions or sentiment. So it's a better sentiment gauge. And this chart, at the time that we're recording this now, the net speculative futures position behind the Aussie USD futures contract is the most bullish or net long that we've seen since late 2017. So it's quite a remarkable measure. What do you think about the COT, Matt? And do you look at other sentiment indicators of this sort?
This is maybe my favorite, I think, of the ones we're going to discuss. And again, that's because it checks a couple boxes. It's people actually putting their money at risk, and it's deeper and more liquid, perhaps, than the nascent prediction markets. One thing I would caution with this, and also with FINRA margin debt and things like that, is you have to have a reasonable basis for comparison. Going to the margin debt, yes, margin debt is relatively high, but we have to compare that to, for example, the level of the S&P 500, because there's more wealth. If someone's trying to run a certain percentage margin, well, that's a different calculation when the S&P is at 7,000 versus when it's at 2,000. So I think some of these raw numbers can be surprising, but if you look at it relative to the size of that market, relative to the underlying, that's where you can get a more reliable signal. But certainly the drawback, as you alluded to with the COT report, is it is a bit delayed. It's not survey data. It's financial data from a Tuesday that's released on a Friday. A lot of times people don't even look at it till the next Monday. So it tends to be stale and can't keep up as well with fast moving markets where sentiment is shifting side to side very broadly. But it is something that, again, checks off some of those drawbacks of the other ones and can provide a good long-term view of sentiment, how traders are positioned. And for that reason, I think it's a very valuable tool to add into analysis and identify, again, some of those extremes where futures traders, which can serve as a decent proxy for spot traders in most instances, may be speculating it to an extreme amount in one direction or another. So this one's certainly in my weekly rotation.
So you allude to like some of the delayed time, and certainly weekly is useful. It's better than monthly, like out of FINRA. But how do you position it relative to, let's say, the sentiment that we have on the retail side? Because we do have some noteworthy retail measures. Forex.com has at least for the major FX pairs, a sentiment exposure through its clients. Subset of market, not obviously the whole market, but all of these are subsets in some sort or fashion, because it's too difficult to measure a market at large, especially in the currency world. Do you use, let's say, this one or other retail measure to compare to like a COT or any of the other indicators we've talked about thus far?
Yeah, this is absolutely it's timely. It captures a decent aggregate amount of money, but the drawback here with this one is just that the forex market is so deep and liquid that traders specifically at forex.com, which this data relates to, may or may not represent the broader, larger banks, institutions, sovereigns, and the positions they're building or not. So I think it can be a good measure as long as we put it into context that this is specifically the generally retail client set that trades through forex.com. But it's timely. It's got a decent amount of liquidity. So I think in those ways, it can be a very useful way to determine whether that sentiment is at an extreme for specific markets.
Mhm. Yeah, and I've been looking at retail versus professional sentiment for better part of 2 decades now, and I found over time that the kind of, especially in a shorter time frame, measures like these are much more interesting and useful for the day to day or intraday
Mhm.
versus the COT, which is bigger for or better for these bigger trends because they do include the larger players like sovereigns who don't tend to get in and out of the markets as quickly. But in that granularity, you see a lot more of that back and forth and that changing of exposure and position and bearing from that category of traders. So I think there is a relative and practical use comparison depending on that time frame. So let's shift to the final like group of that we came up. You called it interest gauge, which we just stuck with. But something like Google Trends is a way of gauging this, and you can position it in such a way to kind of see sentiment. We have here trading versus investing, and that's I think a useful comparison that says generally what are you looking to do? Are you looking to trade? Or are you looking to invest? And the search and comparison over time, usually trading and investing rising together is a very strong sign that there is exposure, there's confidence in markets, and that is generally bullish. Obviously, this is going back from 2004 to present over worldwide in the settings, but you can get into the shorter time frame, and in fact, there's even intraday here, but it's going to get very questionable data signals that
Mhm.
you get from it. But it can be very useful, and I like to compare trading versus investing. And you had a suggestion before we came on air, comparing bull market versus bear market searches and seeing where the degree of interest in search is there. I think there's other settings that you can actually get from Google Trends that are useful for this. Um, but it is quite useful because it's an aggregator of view. There's no money behind this necessarily. It's just a general interest. And to that same point, I think the last of these groups is the more modern version of that kind of sentiment assessment, and that looking at the headlines or looking in your preferred social platform to see what the general mood is. A better way of doing that, I think, and we've talked about using AI in the past, and we'll continue to talk about it, obviously, because it has
Mhm.
value in terms of supporting analysis. But you can do an AI search, which I ran an AI search to see what is the general sentiment around Euro USD according to the tenor of Google News top headlines referencing the currency pair, and I just had it run, and it gave me an outcome that is generally neutral. So take from that what you will. What's your take on utilizing it? I would have to say it's at least better than just saying I looked at 15 tweets, and I think the sentiment in Twitter around or FinTwit is bullish, or here's all the headlines. I read the top five, and they seem to be bearish. So it's a little bit more quantitative in that term. But what are your feelings on this, Matt?
I like that it's a little more objective. I think, for example, with the Google Trends data, right? You kind of have to go that extra step to interpret. Well, what does it mean if there's more interest in trading than investing, and how does that compare to the past? It leaves more on you as an analyst, which is a spot from which insights can emerge, but it's not as objective, I think, as some of the other measures. And I think this applies here. I have seen tools that intake all of Bloomberg and Wall Street Journal articles, et cetera, and try to derive the general sentiment toward markets or political candidates or the economy or things like that. That can be useful. The thing with these is that there's not really an objective track record to compare to. You can't say the trend of sentiment on euro dollar is more neutral than it's been in the past, per se. Maybe you could build a tool or something that does that. But I think it is kind of a promising tool. And this is ultimately what AI is for, right? Is taking this unstructured data and trying to make it more structured in aggregate that we can derive insights from it. So I can't comment much beyond that because it's not something I use extensively, but I think there might be some promise if you can find a way to, again, make it more objective, more actionable in your own trading and investing.
Absolutely. Well, thank you for tuning in to the Trading Global Macro podcast from StoneX. If you enjoyed today's discussion, make sure to subscribe wherever you get your podcasts. I'm John Kicklighter.
And I'm Matt Weller. Join us again next week for more insights into the trends and events shaping the world's financial markets. Thank you.